Being short this month costs you $35, more than you were short in the first place. 5 tiers up, that same fee cannot exist. The bank has made sure of it. This is how the bank treats you at every level of wealth. Not 3 banks, 1 bank, behaving like a different business at each balance. The thing that changes is the price of money. What a dollar costs you to borrow, to hold, to be short. At the bottom, it is expensive. At the top, nearly free. Same building. Watch the price move. Level 1, negative. Your balance is below zero, maybe by a few dollars. The amount barely matters. The fee does not scale with the mistake, it simply activates. $35, the median overdraft fee at large banks. You were short a little. Now you were short 35 more. The system knows one thing, the balance is negative. Everything else follows from that. It is not personal. A model decided this automatically. You call to ask, the hold loops, a script says the fee stands, and it lands on the same people again and again. 9% of customers pay 79% of these fees, a median of $380 a year for being short. Money costs the most for the people who have the least. Level 2, a few $100s. You are not negative anymore, just not yet worth much to them. A maintenance fee appears, $12, $15 a month. It disappears if you keep about $1,500 in the account. You do not have $1,500, so you pay to hold the little you have. Your savings earns close to nothing, 0.01%. The bank lends that same money out at 7 to 24%. You apply for a card. They offer a secured one. You deposit $200 to be given a $200 limit. You lend them your own money, then pay interest to borrow it back. The gap between what they pay you and charge others is the business. At this balance, you are simply too small to compete for. You rent your own money back from the bank. Level 3, a steady paycheck. Direct deposit arrives every 2 weeks, consistent, predictable. The bank notices, not with a call, with an algorithm. The maintenance fee is waived, not because you asked. Your pattern earned it. The first real credit card arrives in the mail, pre-approved. You need a small loan for a car repair, approved in 2 days. The rate is around 11%, not good, not punishing, functional. That 11% is the average. Your score sets where you land. You are a customer now, valued while you spend. Replaced without ceremony if you leave. The same institution that ignored you now mails you offers. This is where banking finally works the way the adverts promised. Level 4, tens of thousands saved. You were consistent, not lucky. Consistent. The credit limit rises on its own. You did not ask. You buy a car. The rate that was 11% is closer to 7. At the top of the range, a new car loan runs under 5%. At the bottom, near 16, about $9,700 more on $30,000. Nothing about you changed as a person. Your risk score did. A banker calls, a real one, asks about your goals, gives you a direct line. If you threaten to leave now, someone would try to keep you. Better rates mean more of your money stays yours. The tilt begins quietly in basis points. The price of money falls fastest for the person who needs the discount least. Level 5, $150,000. Here the rules change, not just the numbers. At $150,000, you cross into Chase Private Client, a named tier, a dedicated banker. The monthly fee waived by design. Preferred rates on lending. Priority when something goes wrong. A banker emails you by name, mentions a detail you gave once. The detail is not an accident, it is training. The fee from level 1 cannot reach you here. It is not intimacy. The banker is measured on keeping you. Understanding that does not make the access less real. This is the first tier, the bank named after you, not your problem. Level 6, 750,000. At 750,000, a different door opens entirely. J.P. Morgan Private Client, a dedicated team, not one banker. Built to feel like the private bank, one tier early. Paperwork lightens, rates drop again. Problems solved in one call. A wire that froze is fixed in the same conversation. No script. You are not a customer here, you are a relationship to keep. The bank stops selling you products and starts protecting your business. Level 7, 1 million. This rung is not the bank's rule, it is the law. At $1 million in net worth outside your home, you become accredited. Or 200,000 in income, 300 with a spouse. A category of investments once off limits is now open to you. Private placements, private equity, venture and hedge funds. A single private deal can ask 50,000, locked for years. The risk is real and your money is locked away for years. It was never hidden. It took capital to reach capital. Now you have both. The rules of what you may own change, not just the price. Level 8, 5 million. At 5 million, you reach J.P. Morgan Private Bank. And in the eyes of the law, a qualified purchaser. 5 million in investments. Funds closed, even to the accredited investor now open to you. Deals that never reach a public prospectus, structured to your timeline. A loan drawn up for one client, yours. The rate on a loan is not published, it is negotiated. The bank does not wait for you to visit, it comes to you. The fee that defined level 1 cannot be charged here, ever. Nothing illegal happens. The bank uses every legal discretion in your favor. The price of money becomes whatever the relationship decides. The whole ladder. 8 levels, 1 bank, 1 building. Same policies on paper, a different price for the name on the account. The bank is not cruel, and it is not kind. It is a business pricing risk. Expensive money flows from those with little to those who need none. Open your account and read the fee you paid this month for being short. Somewhere right now, someone is $35 poorer for being a few dollars short. They did nothing wrong. Money simply costs the most where there is least of it. The bank does not change at every level. It reveals what it always was. That is how the bank treats you at every level of wealth. Which level is your Monday on right now, and which are you climbing toward? One shift changes everything.